Thank you everyone for joining. This is our July webinar, the cream of the crop. We're going to discuss, like Marquise mentioned, a little bit more diverse and broad view of the market and how we're looking into participating into more asset classes with reason. So we're not diluted, we're not deviating from what we do best, but how can we be opportunistic and work with the market and capture the best of the market. So that's the intent of today's webinar. As always, we'll do this on a monthly basis, different topics. If you like a future topic to be focused on, please put in the chat as well, and we'll dedicate a future month for the topic you guys like to hear about. So we'll try to mix it up every month and bring a different perspective, but this is like Marquise and Sammy mentioned, this is for you. So let us know what you like, and we'll continue to focus on that. As always, this is general information about the real estate. It's our perspective on the market. We gather some data, we present some data. This is not a legal advice, not a financial advice. So please consult with your CPA and legal advice before you make any investment decision. So today's topic is about business models. So I want to talk about a little bit, if I zoom out and talk about like general business models on how people think about conducting business outside of real estate and how we're applying the same methodology into investment strategies that we deploy at InvestStream. Coming from corporate background and understanding, where to compete and how to leverage the strength and be more competitive in the marketplace. And given our strategy and our history in the last three plus years in the industry, how can we play to our strength and maximize the profits and returns for our investors? So, there's there's different schools of thoughts on business models, but if you want to think about like how you conduct business, you either conduct business at the core of the service of the product in that big market, and that will be very competitive market. It will be saturated with competition, and it's a different type of competition than if you do a niche approach to a certain product or sub-product in a certain market and a sub-market. So there's this core versus niche and how you approach business in general. So when it comes to like real estate, if you think about the core of InvestStream is multifamily value add, where we go buy apartment complexes, inject capital, improve the amenities, improve the lifestyle of our tenants and our residents, and improve the units for them and add new amenities to take it to a different level, where we can have a higher rent and higher revenue, which will also benefit our investors. So that's the overall recipe of what our core is at InvestStream. There's a lot of benefits of doing that, economies of scale, because we buy big apartments, 100+ units. We buy relatively not too old apartments, 80s and 90s product. We renovate it and push it up to make it current and up to date and take care of maintenance. And that's our core. So if you think about investing in the core, that's what we do. I would say 80% of the time is we're building the team, we're building the expertise. I call it building the muscle, bring in the right team members, growing the team, and building that experience over time, and bring in experience to the team as well. We don't need to reinvent the wheel. We'll bring in a lot of people who had experience already in the space and help us accelerate our journey in terms of the teams and the skill. The second aspect of this, which is improving our processes and operations, introducing systems, optimizing processes, and that will allow us to be competitive in a very competitive space, which is there's a lot of investors in the marketplace. There's a lot of buyers. There's a lot of sellers. So if we don't have volume, then we cannot produce competitive margins. So when it comes to the core, which is the bread and butter of what we do, we focus on areas where we have volume, we have experienced teams, we have optimized processes and systems, so we can generate the maximum margins in a very thin and competitive market. And so if you think about any other industry that is not real estate, it's the same thing. In the retail space, Walmart versus HEB, they focus on volume and the margins are very thin. So the money's made in saving and slashing some of the waste and making sure that they have the right volume in place. So that's the core business model. As opposed to doing something more niche, which is very unique in a very specific market, in a very specific industry. And so niche in real estate can be something that will be localized to a certain market or a sub-asset class in a certain asset class. For example, in multifamily, we talk about senior living. That's a niche product, 55 plus living communities. It's multifamily, but it's niche to seniors in a certain age group. Flex space is a niche product for the industrial space. Medical offices is a niche industry for general offices. So that's kind of what we think about niche. And if you think about it from a product or service, niche is that high-end service that will be a premium. It's like, the BMW versus Toyota. It's, in any industry you can apply what is the volume business that focuses on volume and margin versus the high-end quality products or services that have a lot less customers, and that's why it's less competitive. So the characteristics of niche is normally less competitive. You have less players competing in that space because it requires more skills, like Marquise was talking about early on. It's very specific skill set and experiences that you need to gather as a team. And because it's more complex, it's not the everyday that everybody think about. So it's less complex. There's less players in the space. It's more complex and requires more skills and experiences. Definitely a lower volume. So you're not talking about the tens of thousands of units and the hundreds of thousands square footage that you're competing in the normal big industrial boxes or in the normal multifamily space. So lower volume. But the good news, it's higher margin. So that's what's attractive about it, is you can make more money, more return on your dollar in these spaces. Obviously, you have to solve for all the other issues. And then there's always a barrier to entry when you enter any business on any market. And most of the time, barrier to entry is money related. So you need to invest more. It's a higher dollar value to enter a market. But here, because it's niche, is no longer just a money problem, it's a skill problem, it's a knowledge problem, it's an experience problem. So just wanted to kind of give you a high level on how to think about a business from any industry and apply it to real estate. And at InvestStream, we like to focus on the core, but like I say, we can expand into niche with caution. Moving on, so you get the general idea of core versus niche, and now how can we play in that? So this is a diagram of competitiveness. How can you be competitive and making sure that you're not diluted and you're not doing something that you don't have experience in? So definitely the first thing, you talked about the barrier to entry. If you don't have the team depth and experience in these niche products, that's a non-starter. So that's one diagram, that's one circle, and one checkbox that you have to have in your team. The second thing is niche cannot be something that is completely disconnected of what you do as a core business. So it needs to be adjacent to the core. So when we look at multifamily, we decided to play in active senior after we saw the opportunity there, which I'll talk about in more specifics. But, senior living is exactly like multifamily. It's just specific demographics, specific amenities. But at its core, it's multifamily. Same thing with flex. We already done industrial projects, and we're now just tailoring it down to a certain tenant and a certain demand that is in the market. So it needs to be adjacent to the core. So you have the team, and you're not fully deviating from what you're doing. It's core, it's adjacent to the core, and now you're playing to your strength. And you definitely want to pick the right premium returns, markets, and asset classes to make it worth it, because now you're doing something outside of your comfort zone, and it needs to be worth it. So that's a sweet spot, the way we look at these markets that we're expanding on, and new asset classes that we're doing projects now in, outside of the traditional multifamily, which we'll continue to do. So what I'll do next is I'll go through three identified niches that InvestStream is focused on. We've been working on them in the past 9 to 12 months, and we already have three projects in this space, which is very exciting. The first one is the medical offices. Everybody knows that offices in general is doing bad, and it's in a bad shape. In terms of vacancy, it's very high. This is an example I just pulled from CoStar, which is a third-party data research company in real estate. So this is as of Q2 in Houston. Offices and average vacancy is around 20%. In some buildings, it's 25 to 30%. So that's a very high number. And the demand isn't very great, especially after COVID. So we have a saying in Houston that it's probably going to take us a decade to use what we have already. And obviously, the CBD area, the central business district, is suffering more. All the towers in downtown are more empty than, say, the suburb energy corridor in I-10 and the Galleria area, for example. But office in general is struggling, is driving a lot of loans to default, actually, is driving a lot of loan modification conversations with the lenders. So we see office as an opportunity, but we don't want to specialize in office. It's not our strength. We haven't done it before. We want to focus on medical office, and I'll tell you a couple of reasons why. But if you look at the market point of view, the medical office in a suburb area in Houston, the rent average is higher. So that's a good start. There's more demand on suburb offices, especially medical. So the average vacancy is less than 10%, which is healthy. The months on market to lease a unit or a space is almost 1/3 of the typical office building. So almost 6 months is the average as of June. And then the cap rate, which determines the valuation of the property, is much lower than office as well. So the combination of the demand of the medical field on nicer suburb office spaces is driving that demand. And the demand is driving the vacancy to be low. The rent is higher. And the exit when we enter these kind of projects is much more lucrative, which will be translated into returns. Now, big office, there's a lot of players who are playing in office right now because it's cheap to buy office today. If they have a business plan that they can run and find the tenants and basically convince people to move from another building to their building, because the demand is not there. It's just basically relocating people to nicer offices. So that's its own specialty that we don't want to participate in. But the reason we like medical is, first of all, Baha and Yusuf, my business partners, are physicians themselves, the landlords and users of medical offices. So that's a strength that we have already in the team built in. Secondly, most of our investors are physicians. So they understand this asset class. They love it. They invest in it, and they always give us feedback on the type of properties they want to invest in. So we have guidance from the market and guidance from the partners. We already have a built-in established network of providers, health systems, and connections. So when we buy or build these buildings, we're able to lease them faster than our competition. So that's another strength that we play to. And then finally, we already have established relations on developers. So we don't need to become the experts of building new medical offices. We already have a blueprint and we have partners that we work with on a regular basis. Same goes to the property management. So if you think about the subclass, medical offices is the cream of the crop of offices. We don't want to specialize in offices because we're multifamily focused, but we have to our advantage, the team strength and depth. This is a good market to be in for the next 10 plus years. And it's adjacent to our skills and our background. So that's a medical offices.
What specifically are you looking for in an office space that would qualify it for medical office?
So two areas that I'm looking for. One is ground up development in the suburb area. And it would be fairly small to medium, 2 to 3 stories max, 30 to 50,000 square foot, not more than that. So that's the parameter if we develop it, anchored by hospitals, et cetera. There's a lot of expansion that is happening in Cypress and Tomball, in Conroe, and even in south of Sugar Land in Rosenberg. So kind of following the growth path in Houston, continue to be small, so we can lease them fast and exit fast. So we're not looking for big, grandiose, multi-level, multi-story, but focus on specialists anchored around hospitals. So the second opportunity for medical offices for us is conversion of call them old and abandoned, short, low-rise buildings that are offices that can be converted into medical. So in terms of acquisition, if we find a building that is visible on the highway and it's in the right place, but it doesn't feel like it's a medical building, but it can be converted, that's another opportunity that we're looking for. So either land in the growth area to develop small medical offices or a conversion of low-rise offices in the right locations.
Similar question, what Eric just asked about the medical center versus the senior active living. What are the advantages of going into that niche market? Are you getting some kind of a subsidy from the state or the federal government, or how does it play? Because it seems like a person who is over 55 for an average rent, let's say of $1,500, they ended up paying $700, $800, $900. So where is that shortfall? Who's filling up that shortfall?
Hold your thought. I'll come back to active living because we're going to talk about it in more detail.
Okay.
I would say at a high level, the reason medical is growing, so just to touch on medical and come back to the active living. Medical is, there's shortages of doctors, shortages of physician assistants and nurses, and the demand is ever growing. And the reason for the demand is ever growing is baby boomers. Baby boomers are retiring 10,000 person a day. And we have the biggest shift of that population bubble that is the baby boomer now getting into more need of healthcare and housing. So we have the common thread, though medical is growing anyway, compound with the baby boomers retiring and in need of more medical services and more housing. So medical is strong. The demand is as big as it has been. We have a lot of physicians in the family, and there's shortages in every specialty right now, and that translates into real estate in terms of the demand is outpacing the supply. So medical is here to stay. There's big players, the big hospital systems, the big healthcare systems. They're doing their mega projects. You see Methodist is going into those satellite offices and hospitals everywhere. You see all the moving away from the Texas Medical Center and moving into the different areas. They're about to open the new Methodist here and on 290 in Cypress. That's going to be huge. Memorial Hermann is injecting another $300 million to expand their hospital only inside. This is only Cyprus, around my house. So medical demand is strong. So we want to play in the right demand, and we want to continue to supply that, given the fact that we have high demand for medical services and the baby boomer. I'll come back to the active living in a second. I'll continue on the flex space. Similar story. Industrial is huge. We talked about it in the previous webinar, where there was this huge surge of demand because of the move to e-commerce and online purchases and away from retail. And everybody built the big boxes. You have the Amazons and Walmart needing massive warehouses. But what was not really focused on is flex space. Flex space is growing. Flex space demand is still all-time high. The supply is starting to catch up. This is a trendy thing and people are jumping on it, but still way undersupplied. So that's a great story. And you can see it in the vacancy numbers. Naveed, you asked earlier about the trend. Industrial, I would say, picked up a little bit on vacancy. It used to be in the high 6% in industrial and low 9%, but still very healthy compared to other asset classes like retail and multifamily. This is still much more competitive. So I would say supply is catching up, but you still get a premium rent. You still rent them relatively fast. Within 6 months, they're leased. And your cap rate, although expanded with the interest rate, still very competitive compared to retail. Retail is in the 10% plus right now, compared to the flex space on the cap rate. So if you look at the combination here, is still healthy. I'm showing this as red, meaning that vacancy of flex space is slightly higher than industrial. But still you get the premium rent and the exit is very lucrative. So this is still a good sign. When does this end? It's probably going to take 2 to 3 years until supply catches up with this niche. So this is a perfect opportunity for us to double down on flex space in Houston and Oklahoma City, because Oklahoma City is also a great logistical hub in the US. So those are two markets that we have local teams and we have strong demand that's outpacing the supply. So if you look at flex space, what's our advantage in flex space? Like I said, we're local in both markets. We have boots on the grounds in both. We have both experiences in this asset class. We have 2 projects in Houston, and now we're building one in Oklahoma City. The demand supply mismatch I was talking about, demand is way higher than supply. And we built over the years strong networks of brokers and tenants and the exit buyers. We make those typically 1031 exchange friendly, so we can capture those types of buyers when we finish the project. Typically, our exits are between $3 to $5 million per building. So a lot of 1031 exchanges would love to buy these income steady buildings. And that's kind of what we focus on. The big boxes are more targeted for private equity groups. This is not our strength. In 5 years from now, I'll come back to you and tell you this is our strategy now when we want to sell to private equity. But that's not our goal, at least not in the next few years. Active senior. So think about it again, multifamily, but for seniors. So in senior living is 3 categories. One is active living, which is normally you hear about 55 plus, completely independent living. And then you have assisted living, where you have nursing services provided. And then you have memory care. So those are the 3 phases of senior living. We don't want to specialize in assisted living. That's high operations, complex nursing. It's a different animal and we're not specialized in it. And then same goes to memory care. So what we're focused on is the active independent senior living, which is the category and the demographics that people are downsizing, empty nesters. They want to have a nice lifestyle that is not the traditional assisted living kind of that people think about when you talk about senior living communities. So the niche here is you're not changing your lifestyle, you're just downsizing. Your entire neighborhood is the same demographics. The amenities and the programs and the lifestyle offers within the community is directly appropriate to that demographic. No young people, no college people, no kids in the environment. It's built to rent, but it looks like a small house. So we're going to do a built to rent community, not a multi-family, multi-story senior living facility. So those will be enclosed, gated, built to rent, single story, niche environment, not so big, typically 50 to 70 units. So we also don't suffer on the lease up, on the vacancy side. But get this, in Houston and in Oklahoma City, we've done the research on the comps, and it's almost double the rent, 50 to 100% rent premium over multifamily, which is counterintuitive to your question earlier that, senior, typically you're now on a limited budget and you want to have assistance programs with the city, from the city or from the state. That's not what we want to play in. There are people who just focus on that. Is basically they get their rent from the city or from the state. And those are subsidized rents. But either case, which we're not playing in, but either case, you get subsidized rent from the state and you get the demand factor that I talked about, that the fact that baby boomers are retiring 10,000 person a day. So the demand is all-time high. And what shocks me every time I look at the data, vacancy in most of the good properties is always 1 to 2%. It's insane. So basically, they're always on a wait list. This is a niche product that we want to focus on and leverage that momentum and opportunity before it's too late. Compared to multifamily, which we love and it's still there and we always work to get the next projects online. Average rent in Oklahoma City is $115 and 15 cents per square foot per month. If you go to the 55 plus independent living, it's $1.7 to $2 a square foot per month. Vacancy is almost negligible compared to the average 11.5. In Houston is about the same. It's about 11 to 12%, depends on the submarket. And then the cap rate, because of that healthy rent ratio, the cap rate is much lower. So the exit is also very lucrative. And in this one, typically the buyers are private equity who wants solid, steady income and healthy returns. So this is why we like this active senior independent living as opposed to the traditional assisted living that will be more government subsidized. Again, we're not doing this because there's more opportunity and more money. That's one circle out of the three. We do that because we're local to one of the strongest markets. Oklahoma City is becoming like I don't want to call it the capital of retirement in the southern Midwest, but there's a lot of people who like to live in a safe, low crime environment. And Oklahoma City checks that box for them. Certain areas in Houston, the same. Around, again, all the 99 growth area. I've seen a lot in Tomball and Cypress and in Rosenberg, huge markets for us. So that's our focus areas here. We already do multifamily, so this is just a specialized multifamily. Structure-wise, same amenities, modified amenities, but we really focus here on rich programming to make sure that we're given the maximum lifestyle that these tenants are looking for, or these residents are looking for. Demand supply mismatch, again, checking the box. And we already have established we already building big multifamily, so built to rent communities will just fit right in. And then property management connections as well. So just switching gears to show you some numbers to make it real. In the medical offices, I like to compare things to single family because people like understand single family well. So I wanted to compare things to single family. If you own a house and rent it, what are you looking at? Versus if you invest in a multifamily project versus a medical office to just kind of show you some parameters around it. And there's nothing wrong with either. It's just to show you a comparison. So in a single family here in Houston, if you want to buy a decent 3-bedroom home, which is friendly to rent, it's going to cost you anything from 200 to 400,000. Depends on the area you're investing in. The rent ratio in most of the good markets is 7 to 8% of your purchase price. So that will net around 5.5% cash on cash on a yearly basis on the lower end. But you're the landlord, you're controlling your expenses, you're dealing with the tenants directly, more hands-on, you make a little bit more margin. What I don't love, some people love it, some people hate it, is the big return is dependent on the market. So you don't have a lot of leverage. It's interest rate determines the price, the market, the inflation. You're just following the market. You don't have any say on what is your exit if you want to sell that property down the road, or what's the value of it on a yearly basis. Obviously, you pay down your mortgage, you build equity, and that will be all total profit to you. But you cannot say ROI is X because it's market driven. And we've seen the craziest of market swings in the past 4 years. Multifamily, the price has adjusted significantly, which is great. That's why we're kind of excited about multifamily again. It's coming back. We started to see more investment opportunities. I would say, Marquise, in the last just few weeks, started to pick up. And so the cost per unit is 60 to 90,000. This is Houston data. Rent ratio, much higher than single family. Cash on cash is closer to single family because of all the expenses that kind of went crazy recently in terms of insurance, taxes, labor. It's just the margins are lower now in multifamily, but still healthy 6 to 8% cash on cash. And typically the ROI is about 80 to 100% in 5 years. So that's kind of like the ballpark. We don't participate in any project that doesn't check these boxes. So when we bring something to our investors, it has to fit this criteria. Otherwise, it's not a good investment. If I contrast that to medical offices, we talked about, the cost is much higher. Obviously, nicer, modern buildings. Even if we do conversion, we have to inject a lot of capital to make it worthy of being a medical office. The rent ratio is healthy, but what's nice here, it's triple net. So all you need to worry about is vacancy, because everything else is already covered. And what's nice about medical offices and why we love it, given the medical experience that we have in the team, is you secure long-term leases with annual escalations. They're triple net, and the credit and the guarantees are very strong. So it's almost like guaranteed money, unless you have a very big problem in one of the tenants, with one of the tenants. So that's why we love medical offices. Steady, strong. It's going to be there for a while. And we normally secure 5, 10, 15-year leases with strong medical groups. So that's why we love it. Now, some investors might say, I just want cash money, cash on cash. I want mail money, and I don't want to, move with the market and the speculation and the interest. So this would be a perfect fit for them. We just build the medical offices, we lease it, and then we sell it, or we buy and convert an existing building and improve it. So that would be a niche product for us. The nice thing about these two is property management is relatively low. So the headache of managing the tenants compared to multifamily, obviously, is very low. And the fact that it's triple net, and that's a standard, then you can pass on any additional expenses that comes along the way to the tenants. ROI, slightly higher, but again, if for our projects, if it doesn't check that box of 90 to 120% ROI in 5 years, we don't proceed with those projects. Similarly, on flex space, what's nice about flex space? Typically, lower end build product, meaning it's a steel building on a concrete pad. So the cost to buy or to develop it is much lower. So that's an advantage. We still maintain the cap rate, which was a very high cap rate, which is nice. And the cap rate is a testimony of demand is outpacing supply, even in this high interest regime we're in. So the rent ratio is lower than medical, cash on cash is lower, but again, solid ROI over 5 years. So it's easier to build, faster to build, cheaper to build. The demand is high. That's why we like it. And then finally, senior living, a little higher to build. But if you think about higher to build, not necessarily more expensive to build, like a simple 1,500 square foot building. The building itself is not more expensive. Yes, we'll have more amenities. We'll have a nicer clubhouse. We'll have specialized amenities that will cost more. But the actual units themselves are not any different from any cost-wise. They're not different than building a single family home or a duplex or a quad. Rent ratio, the strongest, 18 to 20%. Cash on cash, 8 to 9%. And that ROI is conservatively 90 to 120%. So that's why we're very excited about senior living in the active side. That is my last slide. I'll share a few things about what we do as InvestStream, but I'll pause here for any questions on today's topic before we proceed on the end of this presentation.
Al is very well versed in a lot of different business ventures, especially in commercial real estate. Here with apartments, as you talked about, being our core of InvestStream, but now expanding into the niche and relying heavily on the team. One of our core values here at InvestStream is community. We want to invest with people that we have strong relationships with. And from that, we're able to get into these niche markets with leveraging those relationships and having opportunities to do quite well with medical office and flex space.
Do you have any projects coming up for senior living on the medical office?
We're actively working on a project in Oklahoma City for the senior living. So I can't share more than that until we have it secured, but we are actively working on a good project in Oklahoma City for the senior side. Medical, we're still in scouting phase. We go through a lot of properties and a lot of pieces of land. We haven't found the one yet, but we're actively looking, mainly in Houston, I would say, and Oklahoma City as well.
Okay.
Speaking of community, thank you for sharing that, Marquise. One, on a personal level, I mean, you know, what else is better than taking care of people who are retiring and they want to have a good lifestyle that is not your traditional assisted living kind of anecdote to it. So it excites me to be involved in a project like that for, you know, our parents and our families who wants to have a nice lifestyle and still be independent. That would be amazing. Same thing for flex space. One of the main reasons I love flex space, it's almost like an incubator for high energy, growth-minded entrepreneurs who they're not startups, so they're not like shaky and they still don't know what they're doing, but they kind of pass that threshold of starting a business and now they're in growth mode. And I feel like flex space is the incubator of growth for those businesses to go to the next level. So it kind of excites me to be in those spaces, and obviously providing roofs on top of families and having safe living spaces. So from a community point of view, it also checks the box for us as InvestStream and doing the right thing for as we help our tenants and our investors as well.
How is the medical office compared to the retail space? Like what are the numbers? I know you.
I would say retail is almost as expensive in terms of purchase price and cap rate and development cost. Retail is a little bit more wild in terms of like it's very location specific. And I've seen good successes in retail in the suburbs in Houston on the development side. But I feel like so for us, we're not expert in retail, although we have added my Uncle Wes in Oklahoma City, who all he did is retail. In general, I would say from a data point of view, the rent ratio is lower. The rent ratio is lower, and so it can be as attractive as medical offices if you have the right location, but it could be a zombie zone if you pick the wrong project or the wrong location. Because if you look at the general data, the averages in Houston, vacancy is way higher than medical offices. But that doesn't do retail justice because if you go to the right locations, there's no space to rent. So I would say less rent ratio, about the same to build or acquire, and it's not as safe in terms of just making sure that you're doing the right retail shop in the right place. So retail is there to stay, but there's a lot of repurposing of retail happening right now, especially after a lot of stores stop needing a retail frontage. There's a lot of repurposing of retail, of how we're going to use the retail and make them more experience-based than just a point of sale to the clients. But this is not an area we're experts in, so I would just keep it there. I would say it can be as competitive as medical, but it's not as safe.
Yeah, thank you.
Yep. All right, moving on. If you joined our newsletter and the projects we worked on, just sharing a summary of what we've done so far in our journey. These are some of the assets under management. You can see here a mix of multifamily, a mix of flex space, and we're actually working on a new construction of multifamily in Spring. We're almost done with phase 1. Phase 2 is coming soon. So more to come on the Spring multifamily development. With the expansion of our team, I was able to bring a lot of experience to the team, and one of them is my Uncle Wes. He worked in the hospitality and restaurants businesses before and developed all the stores over the years in Oklahoma City. So we have a lot of boost now in our development capability and building a team there. Also built some shopping centers in the retail space and small multifamily. So now we have a good balance of value add acquisitions and development projects. And to be honest, with the acquisition is, unless the seller is motivated, we're not even looking. But with development, we're buying the land at the right price and we're doing it in multi-phase. So we're not very sensitive to the market dynamics of interest rate and exit because it's a long-term project. So we're more leaned into development right now, at least this year, until kind of the market adjusts on the acquisition side a little bit more. I was in oil and gas for 15 years, so kind of having that experience of having an entrepreneur early life when I was in college, and then going into corporate full mode, focus on new product development. I had 2 startups in my past, led 3 major business acquisitions and multi-billion-dollar business transformation. My last senior was with General Electric and Baker Hughes before I said, okay, maybe I'll need to do something on my own instead of being a gear in the big machine. And that's where me, Baha, and Yusuf decided to start InvestStream. They're my business partners and cousins. They're the medical people. So I'm the only non-doctor in the family, and that's normally a curse or a good thing. I don't know. But we have a lot of doctors in the family, and Baha is a neurologist, has been successful as a businessman and growing his clinic and practices and being involved in multiple for-profit and nonprofit initiatives. Same with Yusuf. He was a career pharmacist at Walmart before switching into business mode, and now growing his own consulting business for medical practices, and also helping grow the neurology practice for the neurology group. So very blessed to have them. It's always easier to work on exciting projects and go through the tough times and the good times with people that you can share and encourage and challenge each other. And that's a blessing of having that core partnership. And then we're expanding the team. So we now have my Uncle Wes. He comes from Oklahoma, a lot of hospitality experience and real estate development. I'm blessed to have Marquise with us on the journey, native Houstonian, and knows everything about Houston. And he's a local pastor as well. He's my North Star when it comes to making sure that we do the right thing for everybody we touch in terms of tenants and investors and community. So working with him on a weekly basis on acquisitions and finding new opportunities and trying to find something that can work and how to make it work, and being creative most of the time around these what seems to be dead deals every time we look at something. So blessed to have Marquise and the family. And then the rest of the team, as we're growing our operations, our experiences, making sure that we cover our investors and serve them well. We have in-house finance, in-house marketing, and project management as well. So that's the end of my presentation for today. I'm not looking at the clock, but it looks like, okay, we're 4 minutes to go, so not going over. Please let me know if you have any questions that we haven't discussed or covered, or any topics you would like to cover in a future webinar.
We'll be sure that y'all get on our mailing list. That's how you can stay tuned with other webinars that come up. If you're in the Houston area, we do have monthly meetups. You'll get information on that. And then as always, you can find our contact information on the website or at the bottom of the emails. That's a way to get more involved with us. So if you have questions or any ideas that you come up with, or something that you've learned that you want to express or want us to tell you our knowledge about it, feel free to reach out, because like we said, we are here for you because we're better together.
Thank you, Marquise. We have we'll do this always the second Tuesday of every month. This month we just cheated a little bit, but it's always the second Tuesday of every month. And then if you're local to Houston, we do the meetup in Cypress in person the last Wednesday of every month. And if you wanna if you have anyone who wants to attend or miss some of these presentations, all of these will be uploaded to our YouTube channel. And you can also refer to some of our previous presentations throughout the year. With that, we'll conclude our webinar. Thank you very much for attending today. Have a great evening.